Well, welcome everybody. Thank you for joining us. I am joined today by the man, the myth, the legend, Mark Yecies with Sunquest Funding. Mark is a good friend of mine. He and I have done some business together when I was up in New Jersey. That's where Mark is. And he's extremely knowledgeable in everything mortgage. He's been doing this in this lifetime anyway. And he's an all-around great dude. So, hey, Mark, how you doing?
Hi, how you doing, Matt? Thanks for the introduction, the exaggeration, but thank you.
Well, did I miss anything? You want to share anything about you, about Sunquest, about exactly what you guys do, to give a little bit of an intro?
Sure. Sunquest Funding is a residential mortgage lender. We're in New Jersey, and we're licensed in New York as well as a broker. We're a direct lender in New Jersey, and we're a generalist. I mean, we help people finance 1 to 4 family homes, and we're good at it. And most small non-bank lenders are good at it. And it almost feels like if I haven't seen it, it hasn't happened. But then I get surprised once or twice a week with something I've never seen before. So there you go.
Yeah, the real estate industry in general is pretty dynamic. Lots of interesting things out there that we can see.
Yes.
So.
But having the resources to solve problems is important.
Yeah, no question. So kind of what we were thinking about doing here, everyone, is to just kind of give you some perspective on different things that relate to residential lending, and kind of have what we consider kind of a mortgage week. So several, chunks of video with some information that you guys can take away as it relates to types of loans, way they're structured, how to look at buying a home when it comes to getting a mortgage and things like that. So maybe, Mark, what we'll do is just kind of go into describe some different types of loans. And
Sure.
Why don't we start off with kind of some of the unique ones. And let's start with VA loans, because this is an area that I think a lot of people maybe don't pay attention to. There's some great programs for the men and women who serve this country, or who are family members of people who serve this country, because they deserve to have something. And this loan product that's available to them is really, really incredible. So why don't you go in and talk about what VA loans are and what they can be used for?
Okay. VA loans are loans that are guaranteed through the Veterans Administration Home Loan Guarantee Program. If you have served in any of the armed forces, Army, Navy, Air Force, Coast Guard, Marines, National Reserve, National Guard, rather, reserves, you are eligible for VA financing if you have an honorable discharge, or you have served you can be active duty and have served for a certain length of time, or been in combat after 80 or 90 or 180 days. You're eligible for VA financing. You can finance 100% based on Fannie and Freddie loan limits. So in high cost areas, it's up in the 720 range, and in non-high cost areas, it's in the 4s. And there's no mortgage insurance. The VA Home Loan Guarantee Program exists to get veterans into homes. So there's a lot of flexibility in the guidelines, in the credit restrictions. It's a fantastic program. And unfortunately, only 14% of the loans originated in this country are VA loans. So figuring out how to get veterans into homes using VA financing makes a lot of sense. You can finance up to a $2 million loan amount, but there's a formula for down payment once the loan amounts go over the Fannie limits.
Mm-hmm. That's awesome. Now, is there any other requirements? Like, I think, correct me if I'm wrong, but veterans must be, they must live in the home, right? They can't use a VA loan for an investment property.
That is correct. Owner-occupied 1 to 4 family. With Fannie Mae conventional loans, the loan limits change based on the number of units, but with veteran VA loans, the loan limits don't change based on the number of units, so you're stuck with the single family limits.
Okay.
Yes, you must be owner-occupied. Co-borrowers to qualify for VA financing must be a spouse or a veteran. Mm-hmm. Okay, there's no non-occupant co-borrowers allowed with these loans. Mm-hmm. So, for instance, when a young couple buys a first house, sometimes the parents co-sign because they're putting money into the transaction. You can't do that with a VA loan.
Okay. That makes sense. Now, and there's also a special The additional circumstance for a VA loan is there needs to be a special VA appraiser that goes and appraises the house, instead of just kind of the typical third-party appraiser that banks generally use.
Correct. And in New Jersey, there's 2 or 3 guys who do most of the appraisals for VA loans, especially in North Jersey, and we know them because they're one of the guys on one of our loans, on one of our loans that we're originating. The other thing about VA loans is there is what's called a funding fee, which is if you're active duty, if you were active duty from full-time military, and you have your certificate of eligibility, 2.15% of the loan amount is added onto your mortgage if you're a first-time use of the VA of your VA eligibility for home loan. If you're disabled, you don't have to pay it. Okay, and the way that's determined is if you have a DD 214 and you apply for your certificate of eligibility, which you're required to have a certificate of eligibility, it will tell you whether you are exempt from the funding fee or not. And if you believe that your certificate of eligibility is incorrect, you can appeal that to the VA, and even if they make that determination after you've closed, they will then refund you your funding fee.
That's fantastic. I mean, this sounds like a great
Yes.
program. Is there anything in particular that Sunquest does to help people with VA loans that might be different, or is there something that maybe somebody who's served but's not quite sure if they qualify, they should make sure they ask their lender when they're looking to apply for a VA loan?
That is correct. And one of the things that we do is, unfortunately, a veteran, if they served in active duty, in combat situations, they come back with certain disabilities, not just physical, but emotional and cognitive as well. And sometimes there's some credit issues or some employment issues, and we help those veterans work through some of those issues so that they're eligible to qualify for a loan, which we're happy to do. One of the things that veterans should be aware of is there's certain large lenders that advertise as being the VA lender. Much better off going to a small non-bank lender for help, because you get a lot more personalized attention when in doing that.
So for the real estate agents who are listening, I would recommend going and seeking out a lender like Mark or Sunquest if you're not in New Jersey, someone, like a Sunquest Funding early on if you have a client who is a veteran, because if there are certain things they need to work through credit-wise, they can start that process before you get far enough down the road where it's like, hey, let's put in an offer, and they find out that they may not be approved or there's certain things that they need to do. So start this process early. I mean, is that something you would certainly recommend, Mark?
Yes, yeah. Or like with applying for any loan, you want people to be pre-approved before you schlep them all over creation and find out they can't either qualify for the house that they're looking at or get a mortgage at all.
Yeah.
And so doing that will save you time, save your buyer time, and give you the time to work on something that actually will close instead.
Yeah, absolutely. I mean, we can talk about that. Maybe we'll talk about pre-approvals and pre-quals in a little bit. But you mentioned, okay, Mark, Fannie Mae and Freddie Mac.
Yes.
And that is obviously a term that a lot of people hear about, but they're
Yes.
not necessarily sure what those entities are. So could you go into a little bit of an explanation of what Fannie Mae and Freddie Mac are and maybe what the difference between the two are?
Well, Fannie Mae and Freddie Mac which is Federal Home Loan Mortgage Corporation, was originally created to buy loans from savings banks. Fannie Mae was created to buy loans from non-bank lenders. They're very, very similar. They have some small, subtle differences in guidelines. Like, for instance, Fannie Mae has a first-time home buyer moderate income product. And on a two-family, the minimum down payment is 15%. But with Freddie Mac, through that same program, it's 5%. So there's small, subtle differences, but essentially they're the same. And those are called conventional loans that go through Fannie Mae and Freddie Mac. They go through the FHA, VA, USDA, then they're government loans. And anything that's not a government loan, even if it's subprime, is considered a conventional loan. Okay, and Fannie Mae and Freddie Mac securitize loans and sell them on Wall Street, essentially. So they act as a conduit from lenders like us, or whether it's a huge bank like a Wells Fargo or Bank of America. We all close the loans and lines of credit and sell them to Fannie Mae and Freddie Mac so that they can be securitized, and those securities, which are bonds, end up in pension funds, money market mutual funds, and so forth. They're big dollar amounts, so individuals have to have big money to be able to buy those individual securities, because hundreds of loans get pooled into a security.
Yeah. Well, and this, I'm sure a lot of people are now thinking about, The Big Short, that movie, and the housing crash, and saying, well, wait, they're still doing this. And and there is a very specific difference between what caused what happened in '07 and '08 and what you're talking about, correct?
Yes, because back then they said, well, we'll create tranches of different quality of loans. First of all, those loans were privately securitized. So they went through Wall Street investment banks who securitized those loans, not Fannie Mae and Freddie Mac. And so they had A paper loans, B paper loans, C paper loans, D paper loans, all in the same security. And they thought, well, if these D paper loans go bad, we still got all those good loans in there, so it won't cause the security to need to be liquidated. But it doesn't matter. A loan goes bad, it goes bad. And the other issue is that these people who were creating these securities had no idea what was in them. And people buying them had no idea what was in them. So, it was just a disaster waiting to happen, and we knew it. We just didn't think it would be as bad as it was.
Yeah.
So.
Yeah. Well, luckily, most areas of the country have recovered pretty much all. I mean, national average certainly has.
Yes.
Now, Mark, you mentioned also FHA loans when we were discussing VA and Freddie Mac.
Yes.
Could you go into a description of what an FHA loan is? Because that's probably the most common loan that people hear about that's outside of what, a normal, say, 30-year, fixed rate or whatever.
FHA loans are loans that are insured through FHA or Federal Housing Administration. Federal Housing Administration is part of HUD, or the Housing and Urban Development, which is a cabinet in the U.S. government. And basically what happens is with Fannie Mae and Freddie Mac, if there's private mortgage insurance, the first 25% or so of the loan is guaranteed. With FHA, they have mortgage insurance called mortgage insurance premium. Mortgage insurance premium protects the lender against 100% of the payment of the loan in the event of default. So when you pay PMI or you pay MIP, which is mortgage insurance premium, you're not protecting yourself, you're protecting the lender. And so that's the difference. FHA, for all intents and purposes, is modern subprime loans. Some lenders will close loans with credit scores as low as 500 on FHA. Of course, I can't see how that would happen, because if you have a 500 credit score, it essentially means you've never paid anything on time in your life. There's only 3.5% down payment. None of the money in the transaction can be your own. You can have all gift for the down payment. You can build seller-paid closing costs into the transaction. So it's very flexible in terms of guidelines. And even though the down payments are low, the default rates on FHA loans have not been significantly higher than conventional loans. Mm-hmm. So it's an excellent product. Fannie Mae and Freddie Mac have competing products with 3% down, but those have loan limits and higher credit score requirements.
Mm-hmm. Well, so. You mentioned 3%, 3.5% down, and I think a lot of people get into this idea of like, wow, they're going to borrow so much money. How can they afford if they can't have the down payment? And the reality is that they still have to qualify for that payment. So the cash flow still has to be there. We're just talking about their equity value that's in the home. So Correct. Somebody who's going for an FHA loan doesn't mean that they're not going to be able to afford the payment, which I would guess is why the default rates are really not any different than, regular loans that we see.
Correct. And that is correct. And what we've seen, our personal experience with default rates on FHA loans is debt ratios, in other words, their payments, including their mortgage payment, car payments, credit cards, student loans, alimony, child support, are a higher percentage of their gross monthly income. That points, for us, that's pointed more to default rates than actual credit scores and credit history, believe it or not.
Interesting.
So,
Well, that
yes.
makes sense, because if there's these other monthly obligations that people have and they're not, if they got to choose one, right? Oh, well, I'll
Right.
let the mortgage go first and do these other things, right?
Yes, they want to keep the roof over their head.
Yeah.
Historically, that's always been the case. And I'll also throw one other thing in there about low down payments. A lot of realtors say to me, well, I'd rather take this deal with 20% down than this deal with 10% down because it's a stronger deal. And my answer to them is, if they meet the guidelines and they're qualified for the loan, they're both strong deals.
Yeah.
They're both good offers. So pick the one that you feel more comfortable with if they're qualified. If you're getting $5,000 or $10,000 more for a house and it's 10% down, take it. Don't 20% down isn't gonna make or break your transaction.
Absolutely. And that's probably a good way to transition to talk about pre-qualifications, pre-approvals, things like that, because I think a lot of the times real estate agents may not have everything set up for if someone's going to offer a contract where maybe they're going to get, put 10% down on a mortgage and they haven't already gone through a pre-approval process. That's where maybe some of the risk comes into play, because it's, hey, will they actually qualify? Are they stretching? So Mark,
Correct.
if you could kind of go into, explain, because we hear words like pre-qualification, pre-approval, and what those mean, and what are the documents that people should be looking for to really look at a potential buyer and say, hey, this person is well qualified to make this offer and purchase this property.
So first of all, let me say pre-qualification and pre-approval varies by institution. Okay. It's what their requirements are to issue a pre-approval certificate or a pre-qualification certificate. In my opinion, they're generally not worth the paper they're printed on. A gentleman named Jim Weichert in New Jersey, who owns a huge real estate company, brilliant guy, as a marketing ploy in the 90s, came up with the idea that he was going to underwrite his buyers before they went into market so that they would be more qualified than anybody else shopping for a home. And it's since become an industry standard, believe it or not. And basically the difference between a pre-approval and a pre-qualification is that with a pre-approval, usually the loan is underwritten. In other words, an underwriter is seeing pay stubs, bank statements, a credit report, things like that to make a determination about whether the borrower qualifies for the loan or not. That being said, the investigation is not as detailed or as deep as when they're actually applying for a loan and buying a house, which is why sometimes things turn up after a pre-approval is issued that may not have turned up before, because, are they going to go through the trouble of ordering written verifications of employment and things like that? Probably not. A pre-qual is basically a loan officer looking at some pay stubs and some bank statements and a credit report and deciding, yeah, this guy can get a loan. Okay. So a lot of it really is, do you have a trusted source? Do you have a qualified loan officer? That's really what makes or breaks a pre-approval. Okay. And a lot of times in our business, people will say, well, longevity points towards being qualified to make this analysis. It doesn't. I've seen guys in the business for 20 years who still can't take a good mortgage application. Credibility, longevity does not mean credibility. Okay.
Oh, yeah, absolutely. So many people say, I've been in this industry for so many years, so I know what I'm doing. That doesn't mean anything, whether you're in mortgage lending or you are a real estate agent, for that matter. So if you're just new in the industry, we should say for anybody who's thinking about becoming a mortgage officer or a real estate agent, don't think that because you're new that you won't have the same skill set or be able to provide the same level of expertise as somebody who's been in the industry for a long time. Now,
it's right. As long as you have good resources behind you, you can be good at what you're doing.
Exactly. Resources like Sunquest Funding, of course.
Yeah. Thanks, Matt.
I think too, what people often think about with pre-qualifications, like, oh, well, we can just call, the loan officer, the night of we're doing an offer, and they can just kind of take a quick look at things. And that's really, I would say that's a huge myth that is out there in the real estate industry, where people say, well, you could just talk to a loan officer. They'll get you a piece of paper that will say you're qualified to purchase this home. And in my opinion, and I'm going to guess you probably share this opinion, that's doing a big disservice to that buyer, because if that piece of paper gets them through to a contract and then they find out that they're not qualified, they're in for a world of hurt.
Correct. But, well, it all once again, it all depends on the loan officer, how good the loan officer is. I know for me, I can do that. Okay. Mm-hmm. But there are guys who can't. So if it's somebody that you've worked with as a realtor, you've worked with a long time, and they've always done good work, yes, you could trust that loan officer to say, yeah, this works. But if it's somebody you've never worked with before, a company you're unfamiliar with, sometimes just getting a second opinion is good. I do second opinions a lot, and it helps the transaction go forward more smoothly, just knowing that there's two people that have looked at it and it works.
Well, I think too, Mark, you know what you're looking at. You know what to ask for too from a buyer. I think
yes.
The situation I'm talking about, some people will call a loan officer at Joe's Bank, for example,
or one of the big 800 numbers, the big 800 number places,
and all they do is have a conversation. And the buyer
yes.
says, this is what I earn, these are
yes.
my debts. And then they give them a piece of paper without actually looking at because you would never issue, I would guess, a pre-qual or a pre-approval without actually seeing evidence of income and, things like that.
It varies. Sometimes I will admit that I do. But as somebody with my level of experience, I get red flags from conversations right away. Mm-hmm. And when I hear something, I'm like, no, we have to run that credit, or I need to see a pay stub, because I know the questions to ask that bring up those red flags. We're talking about overtime, we're talking about base income versus bonus, we're talking about commission, inconsistent income, and those are all areas that you have to listen for to know that we need more further documentation on this transaction.
Yeah.
I mean, if you've got a school teacher that's been teaching for 7 years in the same school district, and they say, this is my income, it's their income. Yeah. It is what it is.
That's a great point.
Right.
Well, that's a great point. And I think that's a good topic to talk about too, is, Mark, there are different types of buyers who have different types of jobs and things like that. And I think a lot of people, particularly those who may not, there's typical W-2 wage earners, like the teacher who's worked in a school district for 7 years. They know what their income is. But then you have people who are 1099 salespeople, or people who work on, large bonus bases. And they tend to, I don't think that they necessarily try to overinflate their income, but I think they have a misunderstanding of how their income is represented.
Correct.
And so could you talk about maybe some of the differences that people may want to look out for if they're W-2 versus a 1099 versus maybe they have a small salary and a big bonus structure, on how they can help prepare themselves to bring the right documents or the right knowledge to their lender to help them get pre-approved?
Okay. So if you're self-employed, which may mean 1099 with a Schedule C on your tax return to report your income, or you own an LLC, or you own a sub-S corporation where you file on an 1120S return, those are all considered self-employed. If you work for a company that you own 25% or more of, you are considered self-employed. No loan officer can pre-approve anybody without looking at tax, or even pre-qualify anybody without looking at tax returns. So I have a small sole proprietor of a small company, and I say, well, guesstimate your income, and they'll say to me, $250,000 a year. That's their gross revenues. By the time I look at their Schedule C, a lot of times it's $40,000 or $50,000, and that's a lot different. Plus, we average 2 years of income, and P&Ls don't count. A loan will not be underwritten based on a P&L. It's going to be 2 years of tax returns. We average those. And if the most recent year is significantly less than the year before, for instance, we have 2017 and 2016 tax returns, and 2017 is significantly less than 2016, we're only using 2017 income. So if it's a time of year like this, where we're in the beginning of 2019 and 2018 was a good year, you want to get those tax returns done, okay, so that you can use them to help qualify you. And I have a borrower doing that right now. With bonus, we count the base income as it is, and then we average 2 years of bonus. Once again, if the most recent year's bonus is significantly lower than the year before, we're only using the most recent year's bonus. Mm-hmm. A borrower should have a breakout of what their base is and what their bonus has been over the last 2 years. Mm-hmm. Okay, so we only care about the current base, but we care about 2 years of bonus. The other thing is with bonus is that their employer will have to state the likelihood of bonus going forward. Mm-hmm. They don't have to promise a bonus, but they have to say that the borrower is likely to continue to receive bonus moving forward.
So there's a lot more moving parts.
That is correct. Overtime is another issue. Overtime is averaged over 2 years as well. And if it's significantly lower in the most recent year, once again, we're going to count less of it. But so plus, with 2018, we'd have W-2s. That's all we need for overtime. Mm-hmm. And a written verification of employment from the employer breaking out the overtime and the base income. However, we're in a month into 2019 or a month and a half, we would have to see some overtime in the most recent pay stubs to continue to count the overtime.
Yeah, to make
unless
sure that
it's seasonal.
Continues.
Pardon me?
To make sure that continues.
Right. If it's seasonal, like for instance, they're a pool manufacturer, and most of their hours occur, say, from April through August, because that's when the biggest part of their busy season is, then a letter from the employer stating that most overtime is earned between April and August will go a long way to helping them qualify with that income. So you can see there's a lot of moving parts.
Yeah, absolutely. Now, what about also for people who are retired? And I know that fixed income still counts as income, but what about people who have large reserves, say of cash, or maybe they're invested in equities or things that are relatively liquid but not producing a fixed income, and they want to take advantage of low mortgage rates and get a loan if they're going to be buying a property instead of, dissolving their investments and purchasing cash? Are there options for them, or are there other things that they need to do to get approved for something?
Well, there are. Fannie Mae has an asset liquidation qualification program, but it depends on what kind of asset it is. And I have to review that, because I will tell you, in my 25 plus years in this business, I have never done an asset liquidation mortgage. So they're not that common. And the thousands of transactions that I've seen, so they're just not, at the risk of sounding like an old man. But Fannie Mae will count 70% of the asset divided by 360 as the monthly income for that. Okay, they also count retirement income, such as pensions, Social Security, disability, all those things. If you're receiving alimony or child support, they'll count those towards qualifying. However, we can't ask about alimony or child support unless it's being used to qualify you for a loan. So if you're receiving it and you don't want it disclosed, the loan officer can't ask for it. Okay, unless you're using it unless you're using it to be qualified. The other thing, that if somebody is sitting on large reserves of cash, they may want to talk to their financial planner about doing an asset-based loan, because that's really cheap money. You don't have to go through the mortgage process. It's quick and easy. So I would recommend that as a good alternative to getting a mortgage. And usually the revenue, that the interest and dividends that those investments are paying off, exceed the cost of the money. So it's not a monthly cash flow drain, and it's a good alternative. That's something I don't do, but it's something I've seen. I don't do investments, I do debt. And then the other, and I just lost my train of thought. Can you believe that, Matt? And then the other.
You're going somewhere good too.
The other alternative is a reverse mortgage. I don't do them. I know people that do them that are very good at it. And if you're a senior and there's cash flow issues, you can use a reverse mortgage to buy a house. You can also use a reverse mortgage to supplement your living costs If you're in a home that you own free and clear and you need renovations for non-skid floors or handbars or lighting or things, ramps to make your house more livable, and you want to stay at home because you're disabled, that's an excellent product if it's originated by the right loan officer.
Right. I think that's the underlying kind of warning for everything, right? As long as you have the right loan officer helping you through the process, you're gonna do okay.
Correct. There's a lot of fraud in the reverse mortgage side, much more than on the regular mortgage side. So you have to be really careful.
Not surprised to hear that, unfortunately.
When I say fraud, I don't mean that the loan may not be properly originated. I mean that the bad advice.
Right.
Bad
Taking
advice.
advantage of somebody just to get a reverse mortgage out there.
Correct. And there's loan officers and quote unquote financial planners who team up to try and churn seniors money by encouraging them to do reverse mortgages. And it's bad situations. You have to be really careful and get the advice of a elder care attorney if you're going to go in that direction.
Yeah. Good advice. So I want to go back to credit scores, and then we can also kind of parlay that into debt ratios as well.
Sure.
So I mean, you mentioned 500. If you don't have a 500, it means you've never made a payment, or even
a 580. Even a 580, you've never made a payment.
So what are some kind of standard ranges where people want to have their credit scores in, and what are some other ways that people can make sure that their credit scores are improving, or that they actually know what their credit score is?
Well, there's a couple things that affect credit scores most acutely. It's when you have a late payment, it's how recent, how frequent. Those are two of the things that affect credit scores more than anything else. I have a borrower right now that missed one mortgage payment, and their credit score went from 740 to 555 because the missed mortgage payment was last month.
Wow.
Okay. So that's bad. All right. Also, the percentage of open credit that you owe. In other words, if you have a Visa or MasterCard with a limit of $2,000 and you owe $1,980 on it, well, guess what? That can affect your credit score by 50 or 60 points. Mm-hmm. So you really never want to owe more than 50% of any available credit, and you want to pay your bills on time, and you want to have 2 or 3 trade lines, meaning car payment, credit card, student loan. You want to have 2 or 3 of those, and that maximizes your credit scores. The range of credit scores is, somewhere around 500 to around 800, give or take, depending on the repository. To buy a house, the FHA range is like 620 to 660, 680, and then 680 and higher would be conventional, depending on the down payment, because Fannie and Freddie charges higher interest rates for lower credit scores. Mm-hmm. So with 5% down and a 680 credit score, you might want to go FHA. But if you're putting 30% down with a 680 credit score, then you'd want to go conventional. Mm-hmm. Okay, and then on the jumbo side, which are loans that are bigger than the Fannie and Freddie limits, if you have a score below 680, you're paying big time because there's a limited number of outlets for those loans. Mm-hmm. Okay.
So below 680, you're going to be paying a higher interest rate.
Basically, well, really, the premiums start below 740, believe it or not, mm-hmm. but they're significant once you get below 700, depending on how much you put down. They go away with a bigger down payment. So it takes a combination of down payment and credit score to determine which product makes the most sense.
Okay. Now, you mentioned having open lines of credit, and I think a lot of people get this confused as saying, well, I need to keep a little bit of balance on my credit card. And you're not saying that, right? Just having the credit card, still pay off your balance every month if you can, right?
Yes, that's good for credit, actually. And we see we see the most recent activity on the card is listed on the credit report. Mm-hmm. So if it's used recently, that's good. If you have a Chase Visa card that you haven't used in 3 or 4 years, that's not helping your credit. It's not doing anything to your credit one way or the other. It's just sitting there.
So
if you
use
have,
it, but pay it off.
right, a Friday night, if you're used to ordering pizza because you don't feel like cooking, order the pizza, pay it off when the bill comes at the end of the month, just so it has activity on it.
Yeah.
Okay.
And then would you also recommend people, if they've had a credit card for, say, 5, 6, 7 years and they've never had the limit increase, to just maybe request one so that they have more available credit to them if they're using that card?
They could, yes, they could. One of the other things I was going to say about credit scores is people say, well, I got my discovery bill and I show that my credit score is 750. Okay. Those are not real scores. Yeah. Real scores are when you apply for a certain type of credit, they're going to use parameters to determine what the chances are that you'll pay that type of credit late. So your credit score will be different if you apply for a credit card, if you apply for a car, if you apply for a mortgage. They all use different algorithms to determine what credit score is. Mm-hmm. So those freecreditreport.com or Credit Karma or whatever, they're not real scores. You cannot depend on that, because if you've got a 750 credit score on your Discover card, you can bet dollars to donuts that your score is going to be 710 or 720 when you go apply for a mortgage. So you just cannot depend on that score.
Now, everyone is entitled, right, through some program to have a credit report or, achieve their credit score every year. So is there a place where people can go that is a reliable source to find out what their credit score approximately would be?
Yeah, yes, but as once again I said, those consumer scores, they're not real. They're just not. They give you a guide for how good your credit is, but they're not really scores that can be used for any kind of credit.
Right.
You can go to Experian.com, TransUnion.com, and Equifax.com, and they have to give you a copy of your credit report for free every year. You can go on each of those three repositories, request a credit report, and freeze your credit at the same time.
Okay, so best option, go direct to the repository. Don't use any of these other, kind of things that'll... Because then you'll see the loan offers start showing up in your mailbox the next week, right? Like,
correct. When I run a client's credit report, they're getting offers from Quicken Loan the next day for mortgages.
Right.
Believe it or not, because they all sell those lists after you've applied, after your credit's been run.
Yeah.
All the repositories do.
Yeah, that makes sense. So, speaking of credit scores, a lot of people think, if I apply for too many mortgages, like if I apply now, but then I don't buy a house, if, for some reason, then I have to apply again in 4 months or whatever. There's this, hard pull versus soft pull thing. And there is a difference based on what type of loan you're applying for, as far as I understand. So could you talk a little bit about that, and why you don't want to go then apply for a car loan when you also are getting ready to close your mortgage?
Yes. So when you're shopping for a mortgage, you can have 3 or 4 mortgage inquiries all within a very short period of time, like 2 weeks, and it won't affect your credit score. I don't recommend that you do that, okay? Because in my business, guys think, I ran their credit, they're mine now, because they're not going to want to have an inquiry anywhere else. My recommendation is talk to a few different mortgage guys, figure out who you're comfortable with, and then let that person run with your stuff. If you're already on Credit Karma or freecreditreport.com and you know that your credit's decent, don't let a bunch of guys run your credit. Do not give your Social Security number to anybody until you're really ready to apply for credit. That is my recommendation. During the process, if you say, we're going to need a new couch and a new dining room table, and you go to one of these furniture places and they have these consumer loans where you can finance for the first 6 months for free, do not let them run your credit until after you've closed on the house. They will do that. You can give them a small deposit for the furniture and they'll hold it, and then let them run the credit, because at the end of the process, 48 hours before you close, the lender will do a verbal verification of employment to determine if you still have a job, because you cannot believe how many people have lost their jobs and never bother to tell us during the time they've applied for a mortgage. And then we're also going to do what's Matt described as a soft pull. We're going to see if there are any new inquiries on your credit report. Okay, and if those are there, then you're going to have to either prove that you didn't take credit, so you have to, prove a negative, and if you did apply for credit, then we're going to have to see what credit you took credit. We're going to have to see all the documentation that goes with that new credit, and it will delay your closing.
And that was a great piece of advice too about, getting credit reports or having people run your credit. You do have to give your social security number to people. So, there's a lot of identity theft that obviously goes around. And so do be careful about who you're just sharing information with. And I think that's great advice, is to go interview a few people first and decide who you trust and who you want to work with, because it's not always just about, maybe the best rate when you're talking about tenths of a percent or things like that. It's also about the reputation of the lender, their ability to get you across the finish line.
Yes.
And Mark, this is a great time to talk about maybe the differences between a broker, a bank, and a non-bank lender, because although the products that a consumer will receive can be similar, there's a big difference between those three, correct?
Yes. Yes, there are. So, and they all have their place. Okay. Broker is a guy who takes your mortgage application and then places it with a lender, and the lender does the rest. They underwrite the loan, they close the loan, and they collect your documentation. Okay. A non-bank lender is a direct lender. They close the loan in their own name, but all they do is mortgages. They don't do anything else. Many of them, like us, are almost like a hybrid of a broker, because we're not big enough to sell loans to Fannie Mae and Freddie Mac. You have to be huge to do that. So we're selling loans to a variety of outlets, and some of those outlets have appetites for different types of loans. Like some like multifamily, some don't. Some like investment properties, some don't. Some are more forgiving for credit scores and debt ratios and so forth and so on. So it gives us a variety of interest rates and a variety of outlets for loans. So with a non-bank lender, you get that. When you go to a bank, you go to Chase, you go to Wells Fargo or PNC or wherever you go, you are then stuck with whatever they have an appetite for, whatever their interest rates are on that day. And for instance, and I don't know if this is still true, but in my experience years ago, Wells Fargo, their big thing was debt ratios. So if your debt ratio went over 42 or 43, they were not going to do your loan, no matter what the mitigating circumstances are. You're applying for a $500,000 loan on an $800,000 house, and you have $5 million in the bank. Your credit score, your debt ratio is high. They don't care. Bank of America, it was credit score. That was their big thing. So if your credit score was 640, they weren't doing your loan, even though it met guidelines. And plus, the big banks do not want to do government loans right now, because they got killed when they bought up a bunch of these small non-bank lenders that had committed fraud on FHA loans. So they don't want to do those loans now. So it's all, but on the other hand, if you're in the private banking part of, say, Wells Fargo, a non-bank lender just can't match the interest rates you're going to get on a jumbo loan. That's the bottom line. So every lender has their place in what they're good at.
Which is another reason to interview many, so that you can better understand your circumstances, so that you can go with the lender that will best suit your needs.
Correct. And one of the biggest things to watch out for is in-house mortgage companies. That lender does not work for you. They work for the real estate company. Yes. Their livelihood is dependent on doing what the real estate agent wants them to do, whether it's in your best interest or not. I know their fiduciary responsibility is to the borrower, but let's face it, if you're sitting in a real estate office with 50 real estate agents and they're feeding you your livelihood, you're going to do what you have to do to keep your job.
Yeah. Well, and that's something for sellers to look out for too, right? When they're taking, pre-approvals or pre-qualifications from in-house lenders. Not to say that they're bad. There are some great in-house lenders who do a fantastic job, of course. But it's just something to say, okay, maybe we should just ask a few more questions.
Right. Or get a second opinion.
Yes.
Correct.
Absolutely. Now, Mark, you mentioned debt ratios, and that's something we haven't talked about yet. So there are obviously debt ratios that fit within certain standards and things like that. Could you talk about that and maybe how people can help maybe calculate their own debt ratio as they're thinking about getting ready to buy a house? Because maybe they have a little extra money that they could pay off that extra credit card that's maybe impacting their debt ratio.
Sure. So there's basically what debt ratios are is your mortgage payment plus whatever reported consumer debt you have as a percentage of your gross monthly income. So to keep it simple, let's say you earn $120,000 a year, okay, which means you're making $10,000 a month. Let's say the house you're looking at, the mortgage payment is going to be $2,000 a month, including principal, interest, taxes, and insurance. Okay, and you've got a car payment for $500 a month. So now you're up to $2,500, and you've got a student loan that's $100 a month, right? So now you're up to $2,600, and you've got various credit cards that total $200 a month. So now you're up to $2,800 a month. That is 28% of your gross monthly income. You will qualify for that loan based on your income, okay, that you're applying for with those debt ratios. The magic number is really 45.
Okay.
They can go as high as 50. If you don't have some other contributing factor, if you're looking at a debt ratio of 45, then you should not buy the house. In other words, you have fantastic reserves. Your mother-in-law is going to live with you and contribute to the household. You know, you have a wife with, or a spouse, a husband with bad credit, and they're not going on the mortgage because their credit would not allow you to purchase the home, but they contribute to the household, then it's fine. But if you're a single guy who's 25 years old and you're looking at a 45 debt ratio, you're not going to have a life.
Yeah. Yeah, you're going to end up what they call house poor, right?
Correct.
Take that same situation. Now the income is $50,000 a year, right? Or income's $5,000 a month, let's say. So that's $60,000 a year. That same debt situation would put them over 50%, and they would not qualify for that home, right?
Correct. And sometimes we have a situation where a guy is buying a condo and he's bringing two of his buddies and his roommates, and they're going to share the expenses. That's completely different. Right. By the way, guidelines do allow us to count some of what we call border income, but I have yet to see an investor that will actually count border income for qualifying purposes. So just because it's in the guidelines does not necessarily mean that an investor will consider that when qualifying you for a loan.
Right. Yeah. So another thing to think about is, but I have these other things. That does not guarantee that somebody's actually going to say, okay, here's the money, so that you can go purchase that property.
Correct. And people think if they go to a local savings bank, they're going to be more flexible. Actually, that's not true, because the OCC, the Office of the Comptroller of the Currency, which regulates federally chartered community banks, and most of them are federally chartered, not state chartered, they come in and make loan level decisions for these guys. They say, you can't do this and you can do that. Even if historically they've done a certain kind of lending for years, the OCC has now told them they can't do that anymore, even though it may be good for their community. I've seen it before. So it is what it is.
That's good information. So we talked about being house poor, right? And, decisions that people make about purchasing homes. And we've talked a lot about specifics about structures of mortgages, things people can do to qualify. And you and I talk about a lot of other things on the phone when we chat around, just like the decisions that people make, right?
Yes.
And, one thing, this is kind of to bridge this gap of talking about that, when we talk about what's happening with interest rates and what's going on with a buyer's, what I would call their purchasing power or their buying power, and how rising and falling of interest rates impacts that. Now, I'm not saying that people should wait and hold off on making decisions based on where interest rates are heading, but at the same time, it's something that they should be aware of. So, we've heard of things like the 1%, 10% rule, which is an approximation, which, basically says for every 1% rise in interest rates, a buyer's purchasing power on average, depending on the price and other things, decreases about 10%. What would you say about the fluctuation of interest rates and how that impacts people's purchasing power and what they should watch out for?
Well, I don't usually look at it that way. Okay, this is how I look at it. Around here, say the average loan amount is, $400,000. Okay, and rates went up, 0.5% at the beginning of 2018. So the average mortgage payment went up about $200 a month. That's the way I look at it. So $200 a month, if you're buying a $400,000 house, if that's going to impact your ability to afford that house, then you shouldn't buy it. Bottom line, $200 a month. Because let's face it, we all throw away $10 here, $50 there on, stuff that makes you happy. I'm not saying you shouldn't. You want your Starbucks coffee every day for $5, or, you like to go to Best Buy and buy gadgets. So we all spend money that is, that we may not have to spend. And that's the way I look at it. $200 a month on a $400,000 mortgage, that should not impact your decision whether to buy that house or not. That's how I look at it.
Yeah,
And,
I think what I hear you saying, and I agree, is that if you're already worried about a fluctuation of an interest rate, you're probably pushing the borders of your own personal finances, and you should maybe step back and think about that. I mean, when I purchased my home, interest rates went up during the time because it's a new construction, so we had to wait. So it was like, how long do you lock? And
Yes.
interest rates did go up, and we ended up getting stuck with a higher interest rate. But because we weren't pushing the border and the barrier to begin with, that was no problem. And
Correct.
that's what I hear you saying, which I think makes a ton of sense.
Correct. Correct. Yeah. It's about lifestyle and affordability. And that change in interest rates, more than affecting people's ability to afford homes. And I'm not saying there aren't some on the edges that fell out. There were. But it's more psychological than affordable. To me, that's the bottom line.
Yeah.
So-
Well, I agree, especially in the short term. But now if we
Yes.
carry that over long term, if people wait long periods of time, many percentages of interest rate changes, all things being equal on the income side, their buying power is going to get impacted.
Correct.
But even that, though, the home prices are going to change too. So
Yes.
there's so many other factors to play in.
Nobody can predict interest rates. If I could predict interest rates, you and I wouldn't be having this conversation right now.
You mean you still
I-
wouldn't talk to me because you would be
I-
sitting in a castle somewhere?
I didn't say I wouldn't talk to you. I said we would be having this conversation right now.
Good point. Good point.
Right, because really what affects interest rates, and people say, oh, the Fed raised interest rates, mortgage rates are going up. No, okay?
Yeah.
They don't have a direct correlation.
Yeah.
There's an indirect correlation, but not a direct correlation. But what affects interest rates is bad financial news, good for interest rates. Good financial news, bad for interest rates. Uncertainty in the financial markets, like this shutdown or war somewhere or trade war, those are bad. They're bad for markets because they create volatility, and that causes rates to go down. And on the other side, the good financial news, like good employment numbers, good retail numbers, they make rates go up. And right now, you hear people say, oh, there's a flattening of the yield curve. What that means is, and mortgage interest rates follow the Treasury market. And that's how the U.S. sells its debt, through U.S. Treasuries. The 10-year Treasury is the bellwether. That's where all interest rates come from. So if you look on the front page of the Wall Street Journal, or you just go onto Yahoo Financial News, you'll see the 10-year Treasury listed and the interest or yield that it shows. Well, right now, the yield on the 2-year Treasury is higher than the 5-year. That's what we call an inversion in the yield curve, because the shorter the duration, the lower the rate should be. Right now, there's only a 0.15% or 15 basis point spread between the 2-year and the 10-year. It should be a 1.5 or 150 basis point spread. So it's a flattening of the yield curve, and that's because many people think that we may be heading for a soft landing or recession in certain parts of the economy. And so you can see is the reason that the short end is the yields have come up is because the Fed raised interest rates. but the long end is showing resistance against that rising in interest rates because of what they're seeing coming in the future in the economy. So clearly there has not been a direct correlation because rates have stayed relatively low, even though the Fed's raised rates at, what, 1.5 or a point over the last 2 years. Mortgage interest rates really only went up about 0.5%.
Yeah.
So there's your primer for today.
So if you're thinking about buying a house, don't let the lifestyle and your life changes drive your decision there. Don't think that you can time interest rates to make a better investment. And that actually brings up a question of fixed rates versus variable rates when it comes to mortgages too, because people always say, well, now the 30-year fixed rate is the most common, I would say, of mortgages, as most people hear about. But there are, 7-1 ARM, 10-1 ARM, 5-1, and 15 years. Should people be looking at products like that? And I know this is going to depend on life situations, right?
Well, and it also, we're going back to that inversion in the yield curve or the flattening of the yield curve that we see right now. Since there's no spread between the 5-year and the 10-year, getting an ARM doesn't make that much sense because there's almost no difference in the interest between a 5-year and a 30 years because the 30-year interest rates are based on the 10-year Treasury. So right now you're looking at 5-year rates in the neighborhood of 3 3/4 or 4%, and you can get a 30-year fix somewhere between 4 1/4 and 4 1/2. Why would you take a 5-year adjustable and that interest rate risk? Because 5 years in real estate terms is short period of time. Yeah. It's just short. So, a year ago, an ARM may have made more sense, but then you had, all-time low interest rates of 3 3/4. So really, why would you ever take an ARM if you can get a 30-year fix for 3 3/4? So right now they don't make sense. When they did make sense was everybody did 1-year adjustables in the mid 80s when interest rates were 18%. And they could get a 1-year adjustable for 12%. So that's a 6% difference in the interest rate. Yeah, now it makes sense.
Yeah.
And as the interest rate environment continued to change through the early 90s, those rates just kept coming down every year. So that was an instance where a short-term duration loan made sense because you just couldn't qualify for anything at 18%. Yeah. You needed 12% to be able to qualify for something.
Whew, 18%.
Right. Most people don't remember that. Of course, I'm old, so I do.
So maybe selective memory there too for many people.
Yes. Well,
so I would say, to kind of the last topic that I kind of have here on my checklist, which is kind of a good way to go into it, is how people look at the way they purchase real estate. And I know this is something that real estate agents are challenged with when they're talking to their clients and mortgage lenders as well, because people always say, well, I want to make sure I make a good investment. And what I always tell everybody is your personal home, there are components to it where maybe you can make some money long-term, but this is a place where you're going to put a roof over your head and you're going to be spending money on maintenance and things to keep up with it. And you're paying to live there. And in my opinion, it's not a investment in the traditional sense of that term. Right. But, what would you say to people who are like, well, I need to get the best loan so that my investment is better? I'll let you answer that one because I just get confused.
That is such a loaded question. I don't even know where to start. But I'm like you. I say to people, you know what? It's the house where you're going to live. It's where you're going to raise your family. You're going to set down roots in a community. You're going to invest in your life and your lifestyle. And trying to predict what your house is going to be worth in 5 or 10 years is impossible.
Yeah.
Okay. So I try and dissuade. Some people you can't, but I try and dissuade people from buying that way. If you want to invest in real estate, go buy an investment property, figure out the cash flow on your return, and then buy that property based on whether it works or not. Mm-hmm. That's what I say. But you can't. One close to home situation was years ago when my sister and her now husband were thinking about buying a home, and he's trying to figure out the future value of money to 25 cents a month. And I said, Randy, do you love my sister? He said, yes. I said, do you want to stay married? He said, yes. I said, then buy a house and stop this nonsense. And they bought a house.
Yeah, as long as you make a purchase decision that's within your means of your income and things like that, and it's not going to stress you out where this thing that's supposed to be joyous becomes this burden on you, don't worry about what's going to happen, especially like if you are able to maintain your job and, home values go down. As long as you're making your payment, you're going to be okay. And
Yes.
you're buying for a place to live, like you said, Mark. It's an investment in your lifestyle. It's not an investment into your portfolio of assets. Yes. And that's the way I think people should look at it. And they're going to be able to make better decisions that way, in my opinion, too.
Yes.
Because they won't get this myth of well, the house price will go up, so we can stretch ourselves now.
Yes.
And it'll all be okay in 5 years because we'll have all this equity, we'll refinance and, blah, blah, blah. Well, tell that to everybody who bought a house in 2006.
And you're talking to one of those. We needed a bedroom. We had a baby. It is what it is,
Yeah. But so, you made a decision based on your lifestyle and right. What you could afford versus, hey, this thing's going to keep going and we'll be singing in the rain and,
yes,
swimming in coins.
Yes. And I knew at that point in 2006 that the economy was going to turn a corner in not a good way. Mm-hmm. And the day after we closed, I remember thinking to myself, well, what if the market really completely crashes? I said, nah, it's never going to really completely crash. Said, what if it does? What's going to happen?
So it was your fault. You put that energy out there, and that's what happened.
I did. It was my loan that I did for myself that caused the economy to collapse. Correct. That is correct.
Oh, man. I that's great. I mean, so I think really the message to people is there's all of these things out there that you can do with mortgages and things. And as long as you talk to somebody like Mark yourself, who's extremely qualified to have these discussions, you'll make a good decision if you also act rationally. Because, I mean, what it sounds like is some of the guidelines out there don't, necessarily protect consumers against their own, finances. And a lot of consumers think that, but really they're there to protect the banks and what happens when these mortgages are sold, out on secondary markets more so than really, I mean, there's definitely consumer protection stuff out there. Don't get me wrong, but most of these guidelines are to protect that money and that loan, not necessarily the individual.
It's a combination. And consumers are paying higher interest rates right now because of those regulatory pressures. Mm-hmm. The irony of, the laws, the Dodd-Frank and so forth, is that they've caused so much extra overhead and extra work in every loan that consumers are paying significantly higher fees and interest rates because of, we have 4 or 5 times the man hours in every loan than we had in 2007. Now, I'm not saying that we didn't need more man hours. We did, and we wanted greater consumer protections, and we wanted clamp down on all these predatory lenders. But, of course, the money was paying I'll stop. But but that did not happen. Okay, so it is what it is. The other thing that I can say is talk to your accountant, talk to your financial planner. Don't do it in a bubble. Talk to disinterested parties that can help you make a good decision. And if your loan officer doesn't want to talk to your accountant or your financial planner, he's the wrong loan officer or your estate attorney. That's that much I can say.
Perfect. Awesome. Well, Mark, thank you so much for sharing all this knowledge with me and with everybody who's watching this somewhere, wherever it is. We'll probably put some links or something below or wherever they will go for people if they want to get in touch with you, Mark.
Thank you.
Or if there's other links that we have that might help further educate people, we'll put those there. But otherwise, I hope that everybody's enjoyed this. I know that I've actually learned a few more things myself, which is always good, always learning. And if there's questions that you guys have as it pertains to this, you can leave a comment or you can reach out to Mark or I, and we'll see what we can do to get that question answered for you. And we just appreciate you guys, tuning in and hearing some things about mortgages and money and real estate.
Thanks, Matt. Thanks for having me.
Yeah, absolutely.
Thank you.